Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know. First, Anthropic's Pentagon clash backfires, catapulting its Claude app to number 2 as competitor OpenAI secures a defense deal. We'll analyze why this public fight is a turning point and how it could affect AI adoption and competitive dynamics in Silicon Valley. Second, Google declares the Android of robotics, aiming to create a universal OS for a projected $370 billion market. We'll explore how this open platform strategy could transform the proprietary industrial robotics sector and what it means for data ownership. Third, the halo trade sees investors flee AI stocks for physical assets, boosting European markets to record highs. So we'll discuss why this massive capital rotation matters and what it means for tech valuations and the future of investing. Fourth, Vera Rubin Observatory's 800,000 alerts on its first night creates a new data market for alert brokers. Today, we'll take a closer look at this data fire hose and its implications for astronomical discovery and the threat from satellite constellations. Fifth, memory chip prices skyrocket 90% due to the AI tax, forcing a supply chain war in the smartphone industry. In this episode, we'll break down Xiaomi's high-stakes gamble to hold prices steady and what it signals for the future of the market. The President of the United States just called a major AI company left-wing nut jobs for making a disastrous mistake. That company is Anthropic, and the government's attempt to sideline them has backfired in a spectacular way. It all started when the Trump administration sought to block government agencies from using Anthropic's technology. The reason? The company refused to let its AI models be used for mass domestic surveillance or for fully autonomous weapons. A while back, we broke down how this fight really centered on the Pentagon's push for any lawful use language broad enough to sweep in lethal autonomy and domestic surveillance. We also noted that Anthropic's stance actually lines up with DoD Directive 3000.09, which requires appropriate levels of human judgment over the use of force. The clash was about pre-approving future policy changes that could remove that human in the loop. What's fascinating is that the major AI labs have very different rules on this. Anthropic's policy is a hard no on fully autonomous weapons. But OpenAI, for example, took a different route. They also have ethical concerns, but they negotiated a deal that carves out specific prohibitions, essentially getting assurances from the Pentagon. And then you have a company like Google, which actually dropped its earlier pledge not to use AI in weapon systems. So you have three giants with three very different philosophies on a critical issue. As we mentioned a while back, competitors like OpenAI and even xAI were reportedly willing to accept Pentagon terms for unclassified systems, a cheaper concession, because their models weren't cleared for the most sensitive work. In response, Defense Secretary Pete Hegseth moved to label Anthropic a supply chain risk to national security, effectively kicking them out of any US defense contracts. We previously flagged how unprecedented this is historically. That label is used for foreign espionage concerns, not to strong-arm a domestic AI lab over its ethics policy. And remember, Anthropic's Claude is uniquely cleared at IL6 to handle classified material. Blacklisting them wouldn't just hit Anthropic, it would punch a hole in the Pentagon's own workflow. Now, get this. This supply chain risk designation is a powerful tool. The Department of Defense has a framework with over a dozen risk categories, from foreign ownership to cybersecurity, but the key here is that it can be used to exclude a vendor without the usual due process. Some analysts are concerned this is being used as a political weapon to punish companies that don't fall in line, creating a chilling effect on any AI company that wants to set its own ethical rules. We recently talked about a new Pentagon memo pushing speed from campaign planning to kill chain execution, arguing the risk of moving too slowly outweighs imperfect alignment. You can feel that urgency in how this is being deployed, but the attempt to suppress the company had the opposite effect. In a stunning turn, the public appeared to rally behind Anthropic. Its AI assistant Claude, which was ranked number 131 on the App Store just weeks ago, skyrocketed to the number 2 spot in the US charts, right behind its rival, ChatGPT. And believe it or not, this shows a company's ethical stance can become its most powerful marketing tool. After all, consumers are watching. Research from firms like Sensor Tower shows that after this public fight, Claude's free user base grew by over 60%, with daily signups tripling. Even more telling, their paying subscriptions more than doubled. People were literally voting with their wallets for the company that took a stand. But that's not the whole picture. The real turning point is what happened next. While Anthropic was going viral with celebrities like Katy Perry posting their support, its chief competitor was making a major power move. Just hours after Anthropic was blacklisted by the Pentagon, OpenAI CEO Sam Altman announced that his company had reached an agreement with the US Department of Defense. So the thing is, OpenAI made a contrarian bet. While Anthropic chose public defiance, OpenAI chose strategic compliance. Continuing our last discussion, earlier reporting suggested OpenAI had already agreed to Pentagon asks for unclassified systems. The update today is that Altman confirmed an agreement and emphasized safety red lines, no mass domestic surveillance, and preserving human accountability in the use of force. So OpenAI is essentially telling the government, we'll work with you, but on our terms, creating a fascinating split in strategy between the two biggest names in AI. This isn't just a corporate squabble, it's a high-stakes battle over the future of artificial intelligence. A government crackdown intended to punish a company for its ethical guidelines instead created a viral sensation. In the war for AI dominance, one company's principles became a competitor's immediate strategic advantage, and the any lawful use fight we talked about a while back is now playing out in the open, with public sentiment and App Store charts becoming unexpected leverage. Speaking of giants battling over the future of AI, Google just revealed its own massive play, but this time, it's not about language models, it's about the physical world. The CEO just went on the record with a statement that reveals their next massive playbook. His words, "This is the Android of robotics." Think about that. Google became a global powerhouse by creating the Android operating system and giving it to phone makers to compete with Apple's iPhone. To understand the gravity of this, you have to look at their history. The Android model worked because it provided a free, open source platform that let any hardware maker jump into the smartphone race. It created a massive ecosystem of apps and drove down costs for everyone. Now, the company is officially moving its robotics software project, Intrinsic, into the main Google fold to do the exact same thing, but for physical robots. However, if you zoom out, you'll see another layer of strategy at play. The Android playbook might not translate so easily. A smartphone is a commodity. An industrial robot is a highly specialized proprietary machine that has to be incredibly safe and reliable. Actually, the industrial robotics world is full of challenges that the phone world never had, like strict safety certifications and massive initial setup costs that can run over $1 million for a single production line. And the market they are targeting is an absolute bombshell. McKinsey projects the market for general purpose robots could reach a staggering $370 billion by 2040. Google wants to be the company that provides the software brains for that entire revolution. But the story has a complicated, messy history. In 2013, they bought the famous robot maker Boston Dynamics, only to sell it just a few years later after struggling to find a clear business. And that's a crucial piece of the puzzle because it wasn't just Boston Dynamics. Google also shut down other advanced robotics projects like Shaft because they couldn't figure out how to turn these incredible engineering feats into profitable products. So what changed? The recent explosion in AI, Google is now debuting powerful new AI models like Gemini Robotics, designed to bring generative AI into physical action commands that control robots. The situation presents a fascinating duality. On one side, Google is offering a unified platform, while on the other, it's asking fierce competitors like Fanuc and Kuka to give up their own proprietary software. In a stunning reversal, Google is now teaming up with the very company it once sold, Boston Dynamics, to integrate its new AI into humanoid robots. They're also partnering with industrial giants. It's a huge gamble for them. The goal is to create a universal platform so manufacturers can focus on building robots, not the complex software that runs them. Intrinsic CEO says, the goal is to make it so it doesn't matter what the hardware is and it doesn't matter what the AI model is. This is where the situation takes a more complex turn. The deepest competitive advantage in physical AI isn't the robot or even the AI model itself. It's the data. The real world operational data from every movement, every success and every failure. So when Google's software is running inside all these different robots, the question becomes, who owns that data? Google isn't just building a robot. It's positioning itself to be the central nervous system for an entire industry, aiming to dominate the physical world of AI just as it did the digital one with Android. And just like Android collected user data to perfect Google's search and ad models, this new robotics platform could collect physical data to build an unbeatable lead in the future of artificial intelligence. We were just talking about AI pushing into the physical world, but ironically, a whole class of investors is running in the opposite direction, fleeing AI stocks for the safety of physical assets. It's a strategy called the halo trade, and it's fueling a massive power shift away from tech and toward the real world. A while back, we analysed how rapid AI rollouts like Anthropic's were rattling markets and creating that sell first, ask questions later mood. The latest development is that money isn't just leaving software, it's rotating into what AI can't easily obsolete. The idea is to find companies with heavy assets and low obsolescence. We're not talking about software. We're talking about energy grids, pipelines, utilities, and shipping, the gritty physical infrastructure that runs the economy. You know, for years, the smart money used what's called a barbell strategy, balancing ultra-safe assets on one side with high-risk, high-growth tech bets on the other. But the halo trade is different. It ditches the high-risk side altogether. Instead, it concentrates on companies with massive physical assets, which investors now believe are more resilient to the disruptions AI might cause. It signals a major shift in how investors think about risk in the age of AI. As we discussed a while back when Anthropic took a direct shot at legacy code modernization, that speed of disruption is exactly the risk halo traders are stepping around. For over a decade, these sectors were considered relics. Not anymore. But here's a fascinating twist. Are these sectors really immune to AI, or is this just a perception? Interestingly enough, many of these old world companies are now aggressively adopting AI themselves to become more efficient. Research shows that 94% of power and utility CIOs are planning to increase their AI investments in 2025. Remember when we flagged how legacy banking systems hide dark matter in decades-old COBOL, one reason major migrations fail about 80% of the time, and how a misread rule can be catastrophic? That kind of operational risk is a big reason investors are gravitating toward essential asset-heavy businesses that AI can enhance but not replace. The numbers are staggering. Goldman Sachs just reported that its basket of these heavy asset companies has outperformed capital-light tech firms by a massive 35% since 2025. It's what Goldman analysts call a decisive shift back toward physical assets after more than a decade of underinvestment. And the results are shaking up global markets. While US mega-cap tech companies have had a rough start to 2026, the halo trade has pushed both the UK and EU stock markets to record highs. This brings us to a crucial point about why Europe is at the center of this. This shift exposes a huge structural issue. Following the 2008 financial crisis, Europe went through a decade of austerity, leading to a massive investment shortfall in physical infrastructure. We're talking about 550 billion euros per year, less than before the crisis. This left their markets packed with the exact kind of boring industrial and energy companies that are now in high demand. We recently focused on the race to keep critical infrastructure from going obsolete. Europe's backlog is exactly the to-do list investors are now funding. London's FTSE 100, which is stacked with these old economy giants, just logged its 8th straight month of gains. The FTSE's composition is almost like a historical accident that turned into a brilliant hedge against AI volatility. Financials, energy, and consumer goods dominate the index, while the entire information technology sector makes up only about 1.4%. It's a vindication of boring diversification. The biggest winners are companies you've likely never heard of. The best performing member of the Pan-European Stock 600 index this year is not a tech darling, but Frontline, a Cyprus-based oil tanker shipping company, which is up an incredible 57%. As one strategist put it, investors have stopped paying for excitement and are now paying for reliability. This isn't a small correction. It's a fundamental rotation of capital. A senior analyst at Swissquote confirmed that investors are fleeing expensive AI stocks for businesses with tangible infrastructure, echoing the urgency we talked about when AI advances started shaking established industries. And that flight has been fueled by some serious anxiety. We noted a while back how Anthropic's new capability sent cybersecurity stocks tumbling, and how IBM was down more than 22% year to date at the time proof of that sell-first reflex. Continuing that pattern, a speculative report from a firm called Citrini Research painted a doomsday scenario of an AI-driven economic crisis, and it sent shockwaves through the market. The day it was released, the Dow plunged 800 points, and key software stocks fell by nearly 10%. This shows how fragile AI-driven valuations have become and why investors are desperately searching for the safety of tangible assets. in this new landscape. The world's most tangible, real-world enterprises are back in command. And as we've said before, they're the very infrastructure that even AI needs to keep running. From the tangible assets of the old economy, we now turn to a massive new physical asset that's creating a purely digital challenge. A new observatory just turned on its alert system for the first time and immediately bombarded astronomers with 800,000 alerts. That was on its very first night. The Vera C Rubin Observatory went live, and the system started flagging everything from approaching asteroids and distant supernovas to feasting black holes. And if you think 800,000 is a jaw-dropping number, the observatory expects that figure to climb into the multiple millions per night. The implications of this are huge, especially when it comes to asteroids. Right now, existing surveys give us an average warning time of about 9 hours for an imminent impactor, but simulations show that Rubin will be able to push that average warning time to 3.5 days. That extra time is absolutely critical. It could be the difference between simply watching an impact and actually being able to do something about it. Here's how it works. A car-sized camera, the legacy survey of space and time, captures about 1,000 images of the sky every single night. An automated system then compares those images against a reference map of the cosmos, looking for anything that has changed. The technology behind this is a process called image differencing. Think of it as a cosmic game of spot the difference, where a computer subtracts an old picture of the sky from a new one, leaving behind only what has moved or changed. The challenge, though, is that it's not perfect. Initial tests have shown that the raw number of false positives can be 100 times higher than expected, caused by tiny errors or image noise. So the real magic isn't just spotting the differences, it's accurately figuring out which ones are real cosmic events. When a difference is spotted, an algorithm distinguishes what it might be and sends an alert to interested scientists, all within a matter of minutes. What really brought this to a head was the next development. It has created a whole new ecosystem of what are called alert brokers. These are specialized teams and platforms around the world with names like Lazar, Antares, and Fink that grab the entire fire hose of data from Rubin. Each one then filters, cross-references, and sorts the alerts for different scientific goals, creating a competitive market for astronomical data. Some brokers use machine learning to hunt for specific types of supernovas, while others focus on finding asteroids. This means researchers can subscribe to the broker that best suits their own research. It's a completely new way of doing science. This means researchers can rapidly turn their attention to fleeting celestial events that might last only a short time, giving them a chance to study phenomena they would have previously missed entirely. The core conflict here isn't just finding these events, but surviving the sheer volume of data. How can anyone possibly keep up with millions of pings every night? The system's creators plan for this. Researchers can filter the alerts by event type, brightness, or even how many events are happening in a certain time frame. This helps them cut through the noise to focus on what matters most to their work. And a surprising part of this whole story is that it's not just professional astronomers and AI sorting through this. Citizen scientists play a huge role. Platforms like Zooniverse are now integrating machine learning to pre-filter the data, steering human volunteers toward the most scientifically promising or unusual signals that an AI might miss. So this isn't about AI making humans obsolete. It's about a partnership where AI does the heavy lifting and human eyes make the final critical call. But there is a major threat to this whole operation: satellite mega constellations. With thousands of new satellites creating bright streaks across the sky, there's a real risk they could corrupt the images. Research suggests that up to 40% of Rubin's images could be contaminated over its 10-year mission. To fight this, the observatory has developed special algorithms to detect and mask these streaks, and they are working with satellite operators to make future satellites dimmer and less reflective. This isn't just another telescope. The Rubin Observatory is creating a constant, real-time stream of the changing universe, fundamentally altering the speed and scale of astronomical discovery. That data fire hose from space needs incredible computing power to process. And speaking of which, the demand for that power is creating a supply chain crisis right here on Earth. Get this, the price of memory chips, a critical component in every single smartphone, just skyrocketed between 80 and 90%. A while back, we called this the AI tax. The bill just landed. This isn't just a small market fluctuation. It's a massive supply chain war. The insatiable demand for AI data centers is causing memory manufacturers like Samsung and SK Hynix to divert their best, fastest memory chips, what we call high bandwidth memory or HBM, away from consumer devices like our phones. We previously analyzed how Meta, Google, and Microsoft were buying up supply. Manufacturers were retooling lines toward high-margin HBM for servers, and how ByteDance reportedly sought bundled guarantees of scarce HBM and DRAM, exactly the kind of pre-booked capacity that leaves everyone else scrambling. The reason is that AI data centers are on track to consume over 70% of the world's high-end memory by 2026, causing a supply shock that's sending prices for the memory in our phones through the roof. So in the middle of this pricing crisis, Chinese tech giant Xiaomi just launched its new flagship phones, the Xiaomi 17 and 17 Ultra, to challenge Apple and Samsung. But they made a move that has the entire industry watching. They kept the price exactly the same as last year. Continuing our last discussion about the AI tax, this is where that squeeze collides head-on with retail pricing. This defies all market logic. When we place Xiaomi's decision alongside its competitors, the contradiction becomes clear. Samsung reportedly had to raise the price of its Galaxy S25 Ultra by $40, and Apple is said to have increased the price of the iPhone 17 Pro Max by $50, all because of these same memory costs. So for Xiaomi to hold the line at last year's price is a truly audacious move. As we've discussed, deep-pocketed incumbents can often pass that AI tax along and still defend share. The chip crunch, driven by massive demand for AI data centers, is so severe that analysts forecast it could force smartphone prices up by 13% and cause the entire market to shrink by nearly 13% in 2026. We flagged this a while back when IDC projected about a 12.9% shipment drop. The latest forecast lands right on that mark. So how can Xiaomi afford to hold the line? The reality is it can't, and this is where the strategy becomes a high-stakes gamble. Continuing our earlier warning about mid-tier makers being at risk, this is the kind of bet that decides who makes it to the back half of the year. Now, you might be thinking, wait, Xiaomi's a Chinese company. Why can't they just use cheaper chips from Chinese domestic producers to get around this global shortage? That's a great question, and the answer reveals a lot. And the fact is, while China is investing heavily in its own chip industry, domestic producers like CXMT and YMTC are not yet able to produce memory chips with the high performance, reliability, and massive quantities needed for a flagship phone. For a top-tier device, they still have to compete for the same supply as Apple and Samsung. Yes, some budget brands may lean on domestic suppliers like CXMT as a stopgap. That's the tactical buffer we talked about. But for a Halo flagship, it's not there yet. According to Francisco Geronimo, a vice president at research firm IDC, Xiaomi's core weakness is that it lacks the premium market dominance of its rivals. He states that Xiaomi cannot rely on the premium segment to offset low margins in other devices like Apple and Samsung can. Exactly what we noted earlier. Apple and Samsung are positioned to gain share while others take the hit. This decision brings both huge opportunities and comes with inherent risks because Xiaomi's core customer base is in price-sensitive emerging markets like India, Southeast Asia, and Latin America. A price hike of 13% isn't just an inconvenience, it can be a deal breaker. Analysts are warning that this could lead to sharp demand destruction, where customers simply stop buying new phones or delay their upgrades. This could actually create an opening for a resurgence in ultra-cheap feature phones or the refurbished device market. A while back, we said the refurbished market was set to explode. A shock like this could step on the gas. If that was just the appetizer, the main course is just being served. And remember our warning that some mid-tier electronics makers might not make it to the back half of the year? Xiaomi's counter is to lean on a different engine. While Xiaomi's smartphone revenue has been falling, another part of its business is exploding. Sales from its new electric car division have surged by nearly 200%, becoming an essential source of revenue and a critical lifeline as the company fights to survive the smartphone chip crisis. This isn't just a side hustle, it's a strategic pivot that is paying off in a huge way. The key here is the profit margins. In the first quarter of 2025, Xiaomi's electric vehicle business reported a gross margin of over 23%. That's nearly double the margin of their smartphone division, which sits at around 12%. They are literally making more money on each car than on their phones, and they achieved profitability in their EV division in just 19 months. That's faster than Tesla. This is the financial engine that's allowing them to take such a massive gamble in the smartphone market.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.